We are graced with the presence of Troy today, who is going to be helping us understand what it means to have a successful exit in this space, which is something that a very tiny portion of sellers actually ever get to experience in their life. Um, so I don't know. Troy is a buddy of mine since we met at CapCon back in December. And so it's fun just to hang out with him, but it's even better that we get to kind of mine his brain for the knowledge about what made that possible and how to go about exploring the possibility of exiting your Amazon business. So it's pretty exciting.
Yeah,
And
absolutely. Thanks, Chris,
yeah,
for having me. Appreciate
yeah,
it.
dude.
And I'm glad to be reconnecting with you again. Of course, when we connected at CapCon, Chris is a great guy. So I'm really happy to be setting aside some time to chat with you guys and talk about, geek out about, exits, Amazon businesses. That's the stuff that, that's the sandbox I play in. So I really enjoy it. And hopefully answer some questions if you guys are thinking about, if that's on your radar to position your brand or business for sale. Some of the big takeaways that I would want to make sure that you have in mind. It's very rare that it goes perfectly. That's just the nature of life and in business. And so you just have to try to keep the priorities, do what you can, set the stage for that. And then hopefully it's a seamless and happy and mutually beneficial exit at the end of the day.
Heck yeah, dude. Wow. That was very well said. And that made me even more excited to learn about this because it sounds like you kind of have it pretty well organized in your brain. Well, I'm sure people ask you about it all the time, actually. Like, I mean, is that true? Like, you probably get people just coming up to you constantly about it. I feel like I would. Like,
Yeah, no, it is. It's definitely, I mean, now that it's almost been a year, there is a bit more of the diminishing elements of that, I would say. But it's a question I get often. And there was times where I was really tapping my network because I was doing the same thing that most may be doing on today's call is really, hey, what's your experience with this, or what have you seen, or not really being in isolation, but trying to understand from case studies and use cases of what does a successful exit look like. And so that way you can make it more tangible and specific, because it can be this really ephemeral, like subjective exercise that, you think you're doing the right things, you think you're taking the right steps with due diligence, but it's a process, and most processes should have a sequence. They should have milestones. You should know your resources, and you want to be the prepared party at the end of the day when you come to the table. You don't want it to be driven by the acquiring party, because obviously they may or may not have interests that don't align with yours, and so it becomes just, again, looking out, being a good steward of your business, and making sure that you're checking off those boxes, not letting the other party drive some of those parts and pieces.
yeah, dude, that's actually one of the biggest things. So we're jumping in deep here already, which is fine. I love it. It's great. But that was one of the biggest things that I thought about when I was thinking about, what we would cover in this discussion, is that this is a thing that usually happens to someone once or a couple of times in their life, to an entrepreneur. I mean, it's not something that you go through every day or even every year or even necessarily every decade. It's like it only happens a couple times. So it's not like you ever really get to be very experienced at this unless you're like a private equity group that just gobbles up companies and sells them all the time. So yeah, I don't know. Like, how did you go about getting that knowledge so that, like you said, you're not letting the other party drive this? Because I'm sure, yeah, like you said, your interests are at odds. Obviously, they want a better price. They want a cheaper price. You want, better valuation. I'm sure there's lots of, there's many different terms besides just the valuation. But how did you get that knowledge? Where did you go to find that? Is there a resource, or did you just talk to everyone possible?
Well, and I'm very fortunate. I think, one of the things, and this is kind of a truism across business as a whole, is your network really drives your net worth. I mean, it's so cliche, but essentially, having the ability to reach out to a close friend and say, hey, you run a private equity firm. What have you seen? What do you look for? What does my business need to look like? Is really being open and honest with those resources. If you don't have them, build that runway, because that can really be advantageous. If I were to have really just taken seriously private equity offers, my valuation would have been, at the bottom. And I got a really competitive valuation because I pre-vetted, based on the information I gleaned from my network, I pre-vetted the potential suitors and buyers to where there was a filter in place. I wasn't inundated, because you'll get emails, you'll get calls, and you've got to run a business at the end of the day. So that was the most important piece, is creating a filter based on criteria that I gleaned from my network. And so if you need to create a longer runway, vet and get that information from your network. Start being open, being honest, being willing to provide value, so that there can be a value exchange there. So you're not just asking strangers about the latest tips, tricks, or insights. And so yeah, really build your runway. And that's what I did. I took my time. I made sure when I was feeling ready to have those conversations, it became very black and white as to, okay, these suitors are somebody I want to continue a conversation with. I've got limited bandwidth. And so I've got to make sure that at the point of contact, I'm not having 24 conversations. I maybe have 2 or 3. And then, of course, you can always, if the numbers don't line up, you can play those 2 or 3 against one another, and you can be open and honest about that as well, because you want to maintain your integrity through this process. It's very easy to be dubious with your numbers, be dubious with your business practices, just because, as you mentioned, this is kind of a once in a lifetime event. So you get a little anxious. You start thinking about how you can skirt things, and it's not worth doing that. It's far better to do your own due diligence that precedes the due diligence and line everything up. And so I was very fortunate, and we can definitely chat about this as well in terms of who I sold to was the guys that put on CapCon, Ryan Moran and his team. And that, again, at the point of filter, it was very black and white. I really like these guys. They're in my network already. When we were having conversations, it resonated with where they were going to take the brand. And so there was big check marks for me, but also I positioned the business in such a way that I knew that I was checking off their big points as well, which I think is definitely something we should touch on, because I think that's, as sellers, you always want to, well, you don't always want to, you want to get to a sort of a phase in your business where if you're entertaining acquisition or alignment or strategic partnership, that you set the stage for that. Like I said, I'm big into personal responsibility and you being able to drive that. And I was fortunate. Again, a lot of the decisions I made allowed for that to be a seamless process.
Dude, this is so surprising to me. I think it's just because you're such a laid back dude that, like, when we first talked about this, you were like, yeah, man, it was easy. It just happened. I just got really lucky. And like, now that we're really like digging into it, like, it's clear that you really like drove the process and that you like fully took ownership of it. I mean, it sounds like, did you use a broker? It sounds like you did a lot of these things yourself that an outside consultant or a broker would normally do.
I did it myself.
Wow.
I was considering it at one point when it came to the caliber of the suitors at one point. It really had me pondering that as an idea of like, okay, I understand that there's a portion, I'm giving away something obviously to leverage a broker on their network. And so based on kind of just being a little bit underwhelmed with some of the numbers, but then I revisited my business. I looked at the growth of the business, the health of the business, my processes, my people, to make sure that was my business really set up in such a way that it was acquisition ready. And so, I, again, just being cognizant of that, I glean more value and benefit from setting the business up for acquisition as opposed to really getting bogged down. Again, I mean, I'm going to keep stressing that my limited bandwidth, you can only do so many things. And if you're running a kind of a hyper growth business and talk, going out to meals and dinners and calls, and because these suitors are really serious businesses. They don't want to have these quick exchanges. They want to delve into the numbers so that they can formulate, synthesize the business and formulate what makes sense from a valuation, a long-term perspective.
So you're meeting with them in person, like?
Yeah.
Oh wow. Okay. Yeah.
Yeah, so I was having a handful of meetings, and again, this is sort of a little bit before I really formalized that filter. So some of those meetings, I would commit, days and time, and give them very specific metrics that they were looking for that may not be part of my P&L or balance sheet, or those types of things. And it was a time commitment, and so I learned very quickly. I sort of kind of stepped back and said, okay, I can't keep doing this. I can't go to a dinner every night when I want to be in my business, and I would rather have an acquisition ready business than I would be to have dinners and outings, having conversations that are dead ends at the end of the day.
Okay, so you had a number of these conversations, then realized that you needed to go back and reassess some things inside the business to make sure that you were acquisition ready.
Absolutely, yeah. And my runway, I mean, I think it would, it spanned maybe 4 or 5 months from when I was really, I sort of had that conversation with myself and wrote down, okay, this is where I need to be at to be happy with an acquisition. And I was ready to start having those conversations. And so things kind of got formalized, and that I always tried to be cognizant of where the insights and the lessons learned, to be able to really kind of push off. Like I said, it was a lot of the wheat and the chaff. It's just making sure that it was parties that I agreed with in terms of their vision and philosophy. Was I putting the brand in the right hands, which of course my team and the people that were part of the company, were they going to be well taken care of? And then, at the end of the day, does the valuation and the numbers make sense?
Yeah. So what were you seeing as like the types of folks that would come in that you would have these meetings with? Or were they mostly wealthy individuals, or were they mostly private equity groups? Was it a mix of the two, or are there other types of folks that you were meeting with?
It was mostly private equity. There were a few bigger sellers, but then again, you would have conversations, and then the numbers would come out, and it would be just valuations that drop off a cliff. Because you have to think about it from a buyer's perspective, is that if they're not offering up immediate value, it's understandable that their valuation model is probably not going to be advantageous for you.
You mean if they don't have something to plug this into that would immediately grow it, you mean?
Right.
Yeah. If
Absolutely.
It's just a cash flow thing that they're adding to a portfolio, that's very different than if they have some type of ecosystem set up where they plug your business in and it immediately adds more value than they spent to get it.
Right. And so that kind of kills two birds with one stone for me, because if they're just trying to squeeze and get as much juice out of the lemon, the numbers are going to reflect that. And then also on the other side of it is the brand being taken care of? This thing that I've committed so much in the way of time, energy, and resources, I want to see it do well. I want to see it thrive. And so,
yeah, dude, it's your baby.
Yeah, exactly.
So the types of buyers you see are private equity groups who are what? Are they specializing in e-commerce? And they're bundling, a ton of brands together into one kind of big, like Procter and Gamble like portfolio across all different verticals, e-commerce verticals.
I didn't see that as much around the time that I was having those conversations. It was a few private equities had an existing portfolio, kind of in the health and wellness space. Obviously, I was more in the skin and hair care, so it fell under that umbrella. But then there were others where it was kind of viewed in isolation. It was just a straight acquisition, really, really crummy valuation, to where it's almost hard to rationalize. They would just say, "Here's the number," and it's irrespective of a number of important factors. Like I said, it fell into that. It's like, if they can't add value, I can get it. I understand that their numbers are probably less than stellar, but I want value to the brand as it goes on. And that's where you tend to align more closely, where the numbers make sense, and you're putting your brand in the hands of somebody who can continue to blow it up. If it's on a global scale, can it grow exponentially? Can it expand its reach? Can it go omni-channel? You name it. What other levers can they pull to really grow the brand?
Yeah, but what are some of those? So I would love to hear more about this. What are those folks or those organizations that are adding value and that are plugging it in that make them willing to pay more because they know that they can use this and add value to it to help it grow and help it expand. What types of things are they doing? Is it like they have a list of customers already that they could plug your product into, or is it they have a bunch of products that they could sell to your customers, or is it other distribution channels? Like, what are we talking in terms of value add?
Yeah, so I mean, what you typically would want, what I would recommend looking for is what would be considered more of a strategic buyer, is that they have the value add, they have the whether it's the ecosystem, the infrastructure to be able to grow the brand, and those are starting to become more prevalent because there
Cool.
is a symbiotic relationship. Yeah, again, one of my close friends has just started a private equity, and they're sort of, to me, addressing some of the pain points that I saw where there's the rigidity, there may or may not be the value added, that can change on a case by case, but there that opportunity is being presented now where the shortcomings of a private equity with a higher touch strategic model, there's just still a void to fill there, I think, in the space. And I'm starting to see more of that come to be. The guys at Capcom are a great example where they have the insight, they know Amazon optimization, they have the e-commerce connections, they have content channels that they can easily leverage, and so they're bringing all of these exponential pieces to the table. And I think they're going to continue to win the day when the private equity, the classic traditional private equities aren't going anywhere. They're going to sit on a pile of money, and
Mhm.
they're going to give you, here's your numbers, take it or leave it. And I think a higher touch, the market is yearning for it, and as sellers, you should be actively seeking that out, whether it's through network connections, events. To bring this kind of back full circle, Chris and I met at Capcom, and the same way that I met with the buyers was through Capcom. Was an event where we networked, we got close, we had connections, and that conversation continued just by virtue of kind of getting out there and not taking the more typical route, right? Because like I said, those private equities they're always going to be there. So you can always use that route as need, if it fits your need. But for me, that strategic buyer is almost always better to seek out.
Yeah, dude, totally. I mean, it just sounds better for everyone. It sounds like a much better deal. Like it's a better valuation because there is actually more value to the buyer. You have a better chance of seeing that business continue to grow because you know that buyer has resources that they can plug your business into to help it grow. And like, that is your baby and you don't want to just pass it off to some boring private equity group that'll just sit on it and let it stagnate as one of dozens or hundreds of companies. So yeah, that's really interesting. It makes me second guess my own strategy and like wonder if it's better to, yeah, basically do what you did and just hustle by using your own network rather than just letting a broker kind of do all the work. And it kind of harkens to me, it harkens to the fundraising process because, as I have been filling you in on, Troy, I've been involved in uh, a fundraising process over the past couple months. It's fairly unique, and it's the first fundraising process of this scale that I've ever been involved with. So it's a token sale, raising 35 million across 30 companies as a static crypto fund, which is really interesting stuff. But it exposed me to kind of like what you were getting at earlier, where you can sit down and have these conversations and almost like waste your time talking to dozens or hundreds of potential suitors. But when you start to see the same questions or the same problems like popping up over and over again, you realize that the most high leverage thing you can do is actually just circle back to your offering and fix those things. So it's a nice feedback loop.
Yeah, for
But
sure.
Yeah.
Yeah, and I think for me too, in terms of an actionable takeaway, this is something when it comes to even hiring is um, that initial filter. You know, being willing to, for me, as an example where I failed and could have done better is, and having those conversations, stepping back, taking those lessons learned, and creating that filter earlier on. And that way, again, things become far more black and white. You know, when you operate in the
Hmm.
gray, it gets to be very inefficient, and more importantly, you can often be more ineffective. And that's something I think, as somebody who really embraces systems and has been very fortunate to be in business models that are kind of hyper growth. So there's a lot of scale very fast. You have a lot of challenges to scale. Is that protecting your bandwidth by setting up those filters? I mean, again, that's where, and especially in the time we're in now, where there's so many leverageable channels and avenues. You know, if we talk about crypto, we talk about, I mean, even real estate is still in this conversation when it comes to leverageability, and that's what Amazon is. It's a leverageable channel. It allows for exponential growth due to its reach, obviously its infrastructure, and that's kind of the name of the game. So those filters can really help you save your time, mitigate against waste, and be effective as well.
So what do those filters look like? Is that you saying up front in an email exchange before it even gets to the personal interview, like, hey, listen, this is the minimum valuation I'm looking at, or listen, I'm only looking for strategic buyers. So if you don't fit this profile, it might not make sense for us to meet. Like, what is that filter?
Yeah, no, it's a great question. So for me, what that looks like is addressing where the value add is for the business. So if they come and tell me that they are simply looking for, this is a straight acquisition, there's no context, no circumstance in which there's a value add to an existing portfolio or a long-term vision, that's a big red flag for me as well. I also got to be very candid about numbers. Ultimately, was there unique metrics that they needed through my P&L and L and balance sheet? Were they able to glean insights as to what that needed to look like for them? And having those email exchanges before committing to a meeting was really important, because and I don't know if that's like standard practice. I haven't been on the other side, but just being willing to kind of hang out and have conversations, and I don't know if that's part of a pre-vetting process on the PE side, but for me, like I said, I'm in the grind, and so it's like,
Yeah.
oh yeah, go for an hour and a half dinner. It's like I'd much rather be doing either other things or working on my business, right?
Yeah.
So it's yeah, things like that, of just being very practical about, does this look right for me, and what does it looking right for me look like? So is that numbers? Is that strategic value add? And then being explicit and being open and honest with the PE or whoever's the potential suitor in those conversation and exchanges. So um, this can happen more organically. Obviously, when I invest and go to CapCon, I'm already investing in networking. I want to meet and connect with new people. So that led to more organic conversations where, yes, I'm still tell me the numbers, tell me what the strategic vision is, but my investment is already made, right? And so it's a lot different than a cold interaction with the PE.
Yeah. I can imagine. Yeah, that would save a ton of time. And I guess that's something that this comes back to the first thing we said, that that's kind of something you have to learn the hard way, I guess, by just doing it and then realizing, wow, I'm wasting a ton of time and hearing the same thing over and over again until you
Yeah,
realize that, which is what, like, yeah, just this conversation already, just personally, um, is changing my perception of like how this process goes, because I have not been through this process myself, but expect to very soon. So, um, yeah, that is huge. So, what are some of those things then that you had to do to get your business set up for sale? Like, what were the things that were not in order where you were like, oh, whoa, like I don't have an answer to this question, or I really need to get this button down or whatnot.
yeah. I mean, I think in terms of not being able to answer some of the questions, you always have to view, um, just speaking generally, it's going to be the company's going to be viewed from a top-down perspective. So you, as the business owner, need to sort of embrace that same type of perspective. and make
Mhm.
sure that you understand things from the top down. So that doesn't necessarily mean you ignore the bottom, but that means in that relative short period of time, they want to view the health and the growth of the business. And simplistically, that's really your bottom line and your margins. You want to make sure that you're continuing a trajectory, because trends are a big part of the equation. Somebody doesn't buy a business in an echo chamber. They need to see
Mhm.
historical trends, and they need to see a trajectory that is positive moving forward. And there's a few ways that you can positively impact that as a business owner, whether that's through your processes, so making sure that there is a good amount of automation, there's a good amount of documentation behind those processes, and that way that your people are really empowered. So when they're going through this change of party A to party B, that there's not a massive drop off in performance and expectations of what needs to be done. So that is a huge and integral piece when it comes to readiness for sale. But I think, like I said, in terms of the perspective, that's one of the big things, because it can sound a little bit daunting. Oh, all of a sudden you know everything about your business. And I think, again, you've got to be really honest with yourself and with the party that's buying the company. If you don't know the answer to something, you obviously need to make sure that you're being candid about that. I mean, that can open up a
Yeah.
whole can of worms in the process, because you've got somebody coming in and wholesale taking over your business. A to Z, soup to nuts. They have your business now. So, um, you know, treat the process honestly, and be honest if you don't know that information. But at the same time, again, create a long enough runway for yourself to where you're feeling confident in those exchanges, because that's not a good look. It's not a good look to plant any seeds of doubt. And if you have a longer process, the ink may not be dry. You may need to, like I said, you really need to make sure you're setting the stage for an easy transition at the end of the day.
Yeah. That touches on something that like I keeps coming to mind as you discuss your experience of this, is that it sounds like, and I mean it makes perfect sense, but it sounds like trust is like a massive part of this. Like you're saying, like it can be tempting, and since you're deep inside the business, you can probably, I don't know, reallocate numbers from here to there, move some things around on a spreadsheet and make, the valuation seem higher or whatnot, that wouldn't be necessarily detectable from an outsider's perspective. But, just establishing trust and being completely open and honest about everything, even things that are like drawbacks. I'm sure, I mean, it's just a general rule of life, but, specifically in this situation, would make for a better experience for everyone, because then you have established trust. And, I'm sure that when you're honest about something that's kind of a shortcoming, like, oh yeah, actually, no, we don't have a process for that. It's more ad hoc or whatever it is, that's appreciated by the other party. And then they know that, when they ask you questions, that you're not going to try to just give them whatever answer they want to hear, whatever sounds better, that you're just going to be real and honest with them.
Right. Yeah, no, absolutely. Absolutely. I think that's
Yeah.
a big, what I would liken it to. It's very easy, especially, if you're not heavily involved in your books, which again, I would recommend that you do set up weekly, monthly reviews of your P&L and balance sheet at minimum. But if you don't do that, I can liken it to almost when it comes around tax time, where you're like, fudge this, fudge that, things get, moved around.
Mhm.
And, if you don't do that, I mean, I don't recommend that, but I liken it to that, where there's a nonchalance about it when
Yeah,
it
yeah.
comes to working with your financials. And I think you got to think about it. And for me, it was a really awesome opportunity. Great people. I mean, I couldn't line up things better in terms of the people I was working with, the numbers that came together. And so, I mean, shoot, I would spend days and nights just making sure, hey, even though I've already got my processes where I review all of my financials, I spent that extra time to make sure, hey, was every T crossed and I dotted at the end of the day. So you want to become vigilant about your financials. But I think if you're viewing this content, I mean, you already should be doing these types of things. You should be getting your hands dirty in your financials to know the health of your business, the growth of your business. Again, really simplified is just your gross revenue, your AGM, your adjusted gross margin, those types of things. And then the other parts and pieces are you handing something off, or is this going to be a really long, drawn out process? And so while there's multiple facets, that analogy, you kind of understand and start to empathize with, what is this party? What are they going to have to go through to acquire this business? Is it something where if I pluck myself out and I drop them in, is it business as usual? Or is it even better? Is it continuing to grow? So you have to kind of disassociate a little bit, view it from the other party's perspective, and make sure that if you were the one buying the business, are you putting it in good hands at the end of the day?
Yeah. Yeah. And that's kind of a good transition into something that I did want to cover during this conversation and chat, since we have about 10 minutes left before we open some questions, if there are some by the audience. But could you tell us a little bit about like the mechanics of the pass off of the actual transition? Like, I mean, you have to transfer bank account, seller account, I guess all kinds of SaaS services that you use, communication channels with your team. What does that look like? Was that a big part of the process, or tell us a little bit about that?
It wasn't.
Very curious.
I mean, the transition went relatively well at the end of the day. What you obviously have to prioritize is those things that have a little bit longer window. So almost immediately we transitioned use of services. So things that were, SaaS, monthly bills and those types of things. We aim to transition those as soon as possible. And then we would set up milestone dates for the completion of some of the other items, whether it's bank accounts, Seller Central account information. And so I think as two parties coming together, we did a really good job of creating a roadmap for that. And then being willing to accept, hey, there's things that come a month later. Vendors expect to hear from one person and they hear from another. And so part of that, again, is being cognizant of that when you're going through the transition phases at the end of the day. And so for me, we sort of followed a plan. We created it based on the timeline, and then we're just willing to keep communication high. I think that's another important piece, is just making sure that who you're speaking to. If X happens, then Y needs to take place. And so it's very clear, and there's not that mismatch of expectations. That tends to be where both parties get a little bit angry and some feathers get ruffled. But if you have that open line of communication and that understanding, and there, not to say there weren't cases where, let's say my business still got charged for something that was part of the other business activities. There was that open dialogue as to, okay, this has happened, but maybe something else in the future will offset it, and we can work together to make sure that the numbers make sense. So you have to think about that too. I mean, you really work intimately when you go through the due diligence process. Now, mind you, my due diligence process was relatively easy. The team that came in and acquired the business were exceptional, very financially savvy, understood Amazon, understood all the parts and pieces that were in play. And so there wasn't that knowledge curve that had to take place where that often can. And so for me, I probably had probably a bit of an exceptional case, but for others, you're really going to be intimately working with the folks that are reviewing your books, that are asking you questions, that are taking over your business. And so you really want to get a feel for their personalities and how they operate, and making sure that, can you get things, understanding what they may be looking for, can you get that to them ahead of time? Can you package things and plan things in a collaborative manner? So, that's sort of the nature of it. It's a very human and very collaborative process to realize a transition.
Yeah, I imagine. And so what was the timeline on that? If you can share that, from the time that you guys, either the handshake or the actual signing, of the agreement, how long did it take before you were completely out of the business?
It was It was only about a 5-month process. And I say
Okay.
5 month because that was when the conversations really got serious and we were drafting paperwork to the point of acquisition and then a continuation period, excuse me, where I just simply stayed on board and make sure that any loose ends were tied up. And that worked out well for both parties. The team had a vision, and so I didn't need to necessarily add any more value, and that wasn't part of the nature of our deal. And so I effectively transitioned to a new opportunity, and they started to realize that vision. So we didn't have a lot of trailing weeks and months to really elongate that. And I think in hindsight, I think that's beneficial. But again, you kind of, as the selling party, you sort of want to make sure that it's really just making sure that your baby's in the right hands, and that at the end of
Hmm.
the day, when you're waving goodbye and everything's wrapping up, that you feel good about it. And so yeah, I would say about 5 months from really serious to due diligence for us maybe encapsulated about a month. So really not too long, not too strenuous. I've heard horror stories. I know of horror stories. And for me, it was, I'd like to think because the financials were in order, our business was, we operated in a transparent manner. We were process driven. And so, we really aimed to make sure if anybody came in and looked at our business, oh, okay, this is systematic. These are machines are running for predictable outcomes. We got clear objectives. We're doing all these things in a process driven manner at the end of the day.
Yeah, that's. I mean, it sounds like you in particular, more than most businesses, really had your processes buttoned up. Sounds like that made it much smoother process. Like you said, you've heard horror stories. I've heard horror stories as well of these sales going real sour. And I was actually going to ask you a question uh, of what was the ugliest part of the sale, but it sounds like there really wasn't one. Or would you say that there was something that was like that you would have done differently or that was less pleasant?
Um, I don't know. That's tough to say. I guess it's a good sign that I have to really think about it. Mm, no, there's not really anything that comes to mind. It was the right people with the right vision, with the right numbers. So I mean, a lot of the big things, kind of sort of the 80-20 of an acquisition, were really great for me. Um, yeah, no, I think I don't have a good answer for you on that one, Chris.
No, I mean, that's good. That is a good answer in and
Yeah.
of itself, honestly. Um, no, that's cool. In terms of other things besides the cash flow, I guess I'll just ask this way. What were the major things that impacted the valuation?
At the end of the day, my valuation was off the EBITDA. So
Okay.
it's really the health of the company. That's how I view it. I always attribute EBITDA to health, and then the growth obviously being, your gross revenue. Um, but yeah, the EBITDA came off a multiple of that, and we had a conversation as to, okay, this is industry norms, averages, the trajectory, and the vision for the company. And so it wasn't viewed in isolation. That's again where when you're talking with PEs, yeah, it could be an EBITDA multiple, but it's you know it's just so black and white. It's not advantageous for you as the seller.
Yeah. But were there things that affected that multiple on EBITDA? The things about the business, maybe the space it's in, or certain assets you had, like trademarks.
Yeah.
Uh,
Oh, absolutely. Those help. Those can help if that's a sliding scale. So let's say you have a valuation at 6 months, and then you're having a conversation again at 12. Because again, we're in a hyper growth business. There may be even volatility there where there's peaks and valleys.
mhm.
Those types of things, that the assets in the business, the IP, trademarks, the brand equity, the brand loyalty, your list. That's always something to keep in mind. That's sort of that. It can be that X factor in terms of what may not be obvious, but is kind of behind the scenes and is an asset. If you've got a really sizable list in the beauty space, and you're gobbled up by a health and wellness brand, they can leverage that list. That list is gold to them.
Oh, totally. Yeah.
Yeah, and that can help, and that can help mitigate volatility if you're maybe experiencing a short-term decline or anything like that. So things like brand equity, brand loyalty are very tough. It's always great to have a compelling story as a seller to speak to what your brand is and how it's cut through the space and how it resonates, and the story that resonates with an avatar. So you want to really kind of brush up on your advertising and marketing chops to be able to make that compelling. That may not always show up as quantifiable, but it can hedge against the volatility, especially in Amazon. I mentioned that because that can be the nature of our space. You could have a listing go down and all of a sudden, I'm out, 10,000, $10,000 in a day. And it's like, okay, geez, like, that's really detrimental to me having conversations with, hey, come buy my business. It's not volatile, I promise. They see this drop in performance, but those types of things that are tried and true of a solid business and our value and assets can help hedge and mitigate some of that.
Yeah, it's just, that's well said. I just can't, like, I don't understand how you can value things like that. And I guess, like you said, it just creates a fundamental baseline so that it's harder, it's easier to level out that volatility. But yeah, I mean, how do you value a 20,000 customer list versus a 100,000 customer list? Or how do you value trademarks, whether it's a logo image trademark or it's the trademark of the name? I'm sure all of this factors in.
Absolutely. Yeah. And be cognizant. I mean, the multiple that's applied it's a 50-50. It comes from the buyer and the seller. So you're not just being handed a multiple and you're beholden to it. These are the types of things you bring to the table and say, hey, I want to tick up my multiple because I'm bringing things that, my direct competitor does or doesn't have this. Give them a very clear perspective and story behind the brand. That story element, even though it may not show up in the numbers, it can just be a key piece. It really can.
That. Yeah. So true. Like if you have the vision, and I mean, that's kind of reminds me of a story that I heard about a very successful real estate broker who was saying that he's not selling, and I guess this is like probably a famous saying in real estate, but that he doesn't sell the space, he sells like what the space could be. So he'd be selling an empty plot of land, but he would be like, imagine right here you have like the ranch where all the cows will be grazing, and over here you can have your garden and all of that. Like, it's the vision, it's the company's trajectory, not just, like you said, the echo chamber of that slice of time that you have to be selling it. So
yeah. And when you're telling that story, be cognizant of most, again, if we're kind of, I feel like I keep bad mouthing in private equities, but if you have a strategic buyer, at the end of the day, they don't typically want to buy products. Products is kind of the micro. The macro level is they want a lifestyle brand. They want to know how you're going to show up in somebody's life every single day, and positively impact their day. And it gets to be very emotive. And so I think that's a part of that story, is try not to think about, don't get down in the weeds with features and benefits of a product. Think about how you're impacting somebody's lifestyle, because those strategic buyers, that's the stuff that's what gets them excited, because then they can grow. That can become a portfolio of brands. That can be a brand that goes to greater depth and blows up. I'm thinking of Honest Company, those types of brands where they're everywhere. They've got diapers, wipes, you name it, and they become a true and genuine lifestyle brand.
Yeah, no, that's awesome. That's so true too. Yeah. And it's so easy as being in the business. You're so deep into it. You're like, you have your whole mind and body like plugged into the machine that, I think it's common for you to have that misstep of like digging too deep into the weeds and like, well, ours is better than our competitors because of this, and this feature. But zooming out, it sounds like from your experience that, the overall impact on your market and your customer and yeah, your customer base and their life in general is more important.
Right. Absolutely. I mean,
So
again,
we
there's going to be exceptions,
yeah
but
yeah
if you have USPs, you have proprietary elements, call those things out. Those are assets. Those are things that are really driving the value behind your brand. But you don't have to juxtapose yourself against the competition unless they do, and then you can create something compelling behind that. But that's that again. It's somewhat. It's really the human nature. What is emotive really resonates with us, and that's the products we stick with and we're loyal to, and we'll climb mountains for. And so, if you can, optimize on Amazon and have that type of diehard fan, you've created this really great convergence of, customers for life.
hmm That's awesome. You're actually, I think, answering unknowingly a couple of questions that we've gotten here, and we should jump into these since we're approaching the end of our conversation. So, yeah, one we can start with here from Aiden is how do you invest your money from the sale so that you don't have to work a day if you want to?
That's a good question. That's a really good question. What I would say, first things first, when it comes to the acquisition itself, you want to obviously be cognizant of tax advisement and tax strategies. So you can definitely leverage different vehicles to help mitigate some of your tax burden. So do that first. And then on the other side, I mean, and if you're looking for more like investment vehicles, I'm a big believer in multifamily real estate as a really solid cash flow vehicle. And what I would say, and this is really good advice that I've gotten on the other side of the acquisition, is don't rush to be overly optimistic. You don't have to get it all and spend it all. And so I've been totally fine in a high yield savings account and deploying my capital on investments that just make sense. They check off enough boxes, and then I'll play in the crypto sandbox for 10% and dabble with that a little bit. But I try to be really prudent as a investor, and so you kind of want to take on that avatar that once you come into this additional capital to deploy, you need to kind of welcome different levels of thinking, different strategies, but don't rush. That's a lot of the feedback that I got is take your time. Don't feel like now that you have it, you've got to deploy it indiscriminately, but you do the same thing. You just be prudent, evaluate opportunities as they come, and deploy it when it makes sense. But as a vehicle, I really like multifamily, and then I'm continuing to grind and supplement that capital through some really exciting ventures as well. So I'm just somebody who chose not to sit on his hands, but there's too much opportunity out there. We're living in a time of way too much opportunity, and yeah, that's what we're doing with Seller.tools and optimization and Amazon. I mean, again, it's we're living in a really great time of exponential, highly leverageable vehicles, and so that'd probably be the last thing I'd say is look for the most leverage. It's a investment truism, but leverage in real estate, leverage in business. If I see a business that's worthy of investment, and I see the leverageability and the numbers make sense, I'll jump into that as well.
Yeah, sounds like you're not in a rush to deploy. You're
Mhm.
really looking for the good opportunities, the good investment
Absolutely.
opportunities. Yeah.
Absolutely.
By the way, just as a side, being that you mentioned that you like this asset class, um, just as a range, like what can you expect in terms of a yearly yield, percentage return in your multifamily real estate investments? Say you put a
What I
million and spread across, a couple multifamily real estate investments. What can you expect as a yearly yield?
Yeah, I mean, dream properties would be in the 14-15% range, and they can tick up, and it depends on the
Nice.
deal too. Yeah, you want to get in something where you're not locked in to a return, and I don't even mind maybe potentially low months in a deal if I can realize more upside. But a good sweet spot would be around 12-14%.
Awesome. Yeah, that's
Yeah,
great. That's actually higher than I expected you to say. So Yeah,
Yeah, well, I've
that's
been
awesome.
very fortunate too. And this again, I mean, we're kind of coming back to network is that I've connected with guys that are extremely knowledgeable. They know what they're doing when it comes to that space and are betting deals that are just off market and really solid markets. And so, yeah, I mean, stay connected, keep an ear to the ground, provide value where you can. That usually will come back to you. And you know, that's been really fruitful for me on that side of things is going to somebody who I know is, hey, you're the subject matter expert. Give me what you're going after, what you look for, and I'll go back to them again. I'll bring it full circle where they'll offer me a deal and I'll review it and say, well, and what do you think? What's the pros and cons? And that helps me in that vetting process for the right opportunities.
Dude, if there's anyone I know that in this space that is super networker in like the most healthy, like lovable way, it's you. Because like I feel like you network without trying or without seeming like you're networking at all. Like you're just a very genuine dude. And that's probably why you have such an awesome network, is because you're just very real and uh, just a fucking cool dude. Anyways,
Thanks, man. Appreciate that.
yeah, it's true. I think that's one of the biggest things that a listener could take out of this, honestly, is um, network. That's come up over and over again in this conversation, is
Absolutely.
that invest in
Absolutely.
your network. And yeah, I think that comes down to helping other people out, just adding
Right.
value to people, and also just being around. Like you said, like going to Capcom, you're investing in your network by going there. You don't have to go with specific expectations like I want to sign this deal or get that done or meet this person. Just being around. That's how you and I met. We were just hanging out
Hanging
and like,
out.
we got introduced. And
That's right,
now
man.
we're on a
Yeah,
webinar
it's so
together.
true. That's right.
Yeah,
And I would say the same thing, Chris. You're like, exceptional at being genuine, authentic, and that helps when it comes to networking. Is if you can be honest. I mean, I guess that would be the next part of the the networking equation is, trying to really be honest, be driven by integrity, and not try to maybe leech information and value off of others, but really just kind of come in and interact and enjoy yourself in the presence of others, and that's where opportunities can happen organically.
totally, dude. And thank you for that. I
Yeah.
appreciate that. We got another question from Estes Morando. He's saying, would you rather go for one brand per company and seller account for highest chances to exit, or combine different brands and hope the overall package is attractive to a potential buyer?
So one brand in a seller account. I'm assuming across like a number of categories. So there's not really a brand. There's not unity across the brand.
It sounds like that. When he's saying different or combine different brands, it sounds like he's saying different brands, different categories.
Yeah, my stance on this is I would much rather have a unified brand. I'm a big brand guy when it comes to brand equity, brand loyalty. That's what tends to serve you off of Amazon as well. Is that if you have that brand recognition, people can and will go out of their way to find you. And so I like that. I like that a lot more. Unless somebody can present me with a strategy with what they intend to do with kind of a diffuse, maybe not correlated products, a pretty diffuse product mix. I'm not too high up on that. I have seen there has been, and I've seen examples of that working, but it was very clear from the beginning there was a plenty of capital. They did their best to unify the branding, whether it was a brand philosophy underneath these brands or some way of still unifying them. So there are examples of it working, but from my perspective, because I'm a big brand guy, is I like to make sure it's more of a slam dunk and that the product mix fits and it's all unified. And then I'd rather go to a greater depth there. I think it can lend itself to just being too opportunistic, and that can show up as being a bit of a muddy brand and muddy presence, and can be viewed as much from a potential buyer.
Yeah, that makes a lot of sense and goes back to kind of what you were saying about zooming out and looking at the overall impact on the market and your ideal customer's life as a whole. And if it's just kind of an opportunistic, like you said, style brand where they just sell whatever sells, um, that's actually not even a brand. That's just a cash flow. So I
Right.
imagine you would really only be getting offers from the kind of private equity groups that we've been shitting on this entire time, rather than the strategic buyers going that route. So, oh, good. All right. Estes said that answered his question. So that's good. Thanks. Uh, Victor says, if we are a brand on the high six-figure profits, what is a good estimated multiple on EBITDA?
Oh boy, that's a good question. I mean, I would want to know a few things. What category are you in? What does your trailing, get like your trailing 12, 24 months to see? I mean, a good solid competitive EBITDA multiple would be, if you can get 2.5, 3x more, that would be ideal. But I would want to know a little bit more about the circumstance there as well. And he's mentioning a six-figure. Um, what was his numbers again?
High six-figure profits. So I'm assuming he means high six-figure profit per year. And I guess that is EBITDA. I think he's saying high six-figure EBITDA.
Nice, very nice. Yeah, I mean that sounds like a solid business. And again, I mean some of the things that we've talked about in terms of readiness, assets that you can kind of cobble together with that. The numbers are solid, but again, not knowing the space really. This it's sort of the I hate to be a hypocrite because I hate to give you a multiple and then the PE is going to be on this side and the strategic is going to be on this side. But on the strategic side, I mean, you can get 4 and 5x. We've seen those types of multiples, but you've got to come in and be providing to them what they need at the end of the day. I hope that answers his question. What I would tell him is to strive for that. If you have that kind of solid return and you have the track record and your financials show a trend, you've got the health, you've got the growth, you've got your processes, you've got your people, you've got all of your ducks in a row pre-acquisition. Push extremely hard for 4 to 5x. Find that strategic buyer, create that brand story, and I mean, that's a solid return. Congrats, Victor, on the numbers. That sounds like a solid business you've got put together.
Hell yeah. Yeah, dude. Good luck on that. It sounds like he's going through the process that you were a year ago. All right, let's do one more question here since we're an hour in now, officially at the official end of the webinar. And so it's Aiden again, and he asks, how do you spend your time right now when you don't have to worry about money?
Oh boy. I'm working as hard as ever. So, Chris, as you know, and I believe if this is the Aiden I know, he might know that I'm working on a optimization platform for Amazon sellers, Seller.tools. I'm one of the co-founders, and that's taking up all my time. We've as with Amazon sellers, where there's so much potential and opportunity, it's the same thing for us at Seller.tools because it's kind of a space that people haven't been as excited about, and we kind of want to reinvigorate that excitement by addressing the pain points that we had as sellers. Leveraging Amazon data, leveraging more of it. Daily updates of key metrics. All these really important parts and pieces that make up the platform. And so we have the fun challenge of putting that in the hands of sellers. So that's what most of my days look like is having fun chats with Chris and others, and really trying to get the word out, and then also behind the scenes making sure everything works as intended, that the value is there, our customers are taken care of, and continuing to grow that platform.
Awesome. All right. That was the last question. Also, Victor says, thanks, guys. So good answer to that question, Troy. Cool. Well, that about wraps it up, dudes and dudettes. People were coming in and coming out, the entire time. We're gonna just take, so this is the official end of the webinar. However, we're gonna take just 5 minutes right now to allow Troy to screen share with us, and share that project that he has been alluding to, the entire webinar, Seller.tools. That
Of course,
some of
we
you,
don't need to do that.
what?
We don't need to do that.
Oh,
That's okay.
I mean, I personally would like to do it if you're able to. If you don't want
Well,
to, that's fine.
yeah, maybe
Um,
we can reconnect on that because I want to make sure I've got it ready for you guys because I'd love
okay.
to give kind of an intro primer. I know we may have a few Seller Tools users joining us as well, but I'd
Mhm.
love to kind of give an intro primer for you guys. Obviously, it does have a 14-day free trial, so I wouldn't want to hold anybody up. But yeah, just kind of highlighting some of the key features, some of the things that aren't available anywhere else tend to be kind of where the questions lie. But yeah, no, I appreciate that. But yeah, I think you and I can connect again on that. We can give everybody a quick Seller Tools primer.
Okay, that's cool too. That works, dude. Um, I was excited to see you, one of the founders, do a walkthrough of this tool that is actually really exciting and pretty groundbreaking in the space. We can just get together separately on that, and that'll be an excuse for us to do another one of these. So
There we go. Hey, I'm down for
that's
that.
my anchor. That's like the ex-girlfriend that keeps leaving another sweater at your house so she can come back and pick it up.
That's
Um,
exactly how I describe you. That's great.
oh, great! I'm in that bucket now. All right, cool. Uh,
Only kidding. Only kidding.
all right. Well, maybe at the very least, because we actually, from the time that we said that, we actually had more people join, and even though we said the webinar ended, people are not leaving. Can you just give us like the 1 minute or like 2 minute pitch on like why Seller.tools is so different and like why it's filling in those missing parts that you were mentioning that as a seller you had?
Yeah.
Because I
No,
mean,
absolutely.
you should be able to brag about this because it actually is awesome. So like people want to hear it, and I want to hear it. So
Yeah, man. No, absolutely. And thank you for a chance to do that. I mean, the biggest thing. So starting from the top, so it's an optimization platform. So the name of the game is driving more organic sales and supplementing your PPC efforts on Amazon. And the biggest point of difference at the top is that we leverage actual Amazon data. This used to be something that we all used to yearn for. It's like, oh, we're using these tools that have Google, Bing data. They have logic behind data sources that are irrelevant. And so we start with Amazon data. So we've kind of cracked the code there. And then with that Amazon data, we bring into some of the most insightful metrics that we can. Things like a relevancy percentage that positively impact your organic and paid efforts. Things like a TSI, which is a convergence of volume and relevancy. So you can easily sort and filter what am I relevant for that has a ton of volume. We have exact and broad impression data that comes right from Amazon. So these metrics and these insights are hugely impactful in your business. And then there's a bunch of other kind of fun features where you can pull your competitors back in search terms. One of my favorite features is the AMZ report card, where you can pull. It's comes from Amazon, but what they do is they describe a listing in 100 keywords. And so you can kind of think of it like a superior reverse ASIN is what I like to call it, because you're getting it from Amazon. It's how they describe the listing in keywords, and you can pull those keywords and drop it into your keyword manager in Seller.tools. Some of the other big things is that we update our data daily. A lot of, again, I don't want to bash other platforms, but that's something that, again, is kind of missing out there. Whether it's monthly, we've seen as old as data that's almost a year old, and the space doesn't really reward that type of old data. Your data can't be rusty. It has to be fresh. It has to be new. And that's where the insights come from at the end of the day. And so that's what I'm really excited about, man, is that leveraging actual Amazon data, metrics that you can only get through Seller.tools. It's updated on a daily basis, and it has huge implications. We are so excited to be bringing more use cases and testimonials out to the market. We've had such great feedback. We've had one of the guys in our group, Jan, has almost 2x his business, by leveraging the data in Seller.tools. And that's not going out and throwing money at PPC or throwing money at external traffic. It's just taking what you already have to do from keyword research and creating a listing and driving organic and paid performance on Amazon. So I've done a terrible job of covering that in a minute. So that's probably like a 3-4 minute pitch, but that's really what we're all about, is Amazon optimization and getting our customers more sales at the end of the day, both organic and paid, never just 50% of the equation. We want 100% of that pie, and that really helps blow up your business.
Damn, dude, that was really well said. And makes me really excited to actually dive deeper into Seller.tools. I have an account myself, but I haven't gotten the chance to dive really deep. I've used some of the easier features, but that is so compelling. Um, it feels good to have a unique, offering that nobody else has, huh? Like you guys
That part is
spent,
nice.
yeah, like you're not, it's so, no one could construe this as snake oil or as something that already exists that's just a rehash. This is seriously unique. And yeah, like, I mean, like you said, those little treats, like pulling the back end keywords from your competitors' listings, that's awesome. And oh, and the 100 words thing, um, that where like it describes your listing in 100 keywords, and that's like how Amazon sees your listing. That when you said that, I was like, oh, like I'm definitely gonna check that out like right after this call. So
Oh, I love
that's
it. I'm telling you,
sick,
and
dude.
if I could just nerd out on that, Chris, it's so cool, because what we like to call internally is kind of like the lazy keyword research. Is you go to your top 3 competitors, you pull this AMZ report card, you have this list of 300 keywords, you bring that into your keyword manager in Seller.tools, then you see if you're indexed, you check your relevancy percentage, you check your TSI, you find out how much you need in the way of giveaways for a 1 or 8 day schedule for a launch. You have all these insights,
Oh,
and you've done it in 10 minutes. You've run this AMZ report card takes about 3 seconds to run on a per ASIN basis. So you've just gathered 300 keywords. I mean, again, Brendan and I, one of the other co-founders, will talk about how we used to spend hours and even days just doing keyword research. And then you've got to create a listing. And we have a listing manager tool on the platform. That's probably, if not right behind AMZ report card, it's up there as one of my favorite features. But it allows you to take all that data that you've mined and drop it into the listing manager, and then weight the keywords that you use based on that TSI, that metric that I mentioned. So that way you're always putting your highest value keywords in the most beneficial place on your listing.
what does that
Yeah,
mean?
man,
Wait, like so like the most important, most relevant, most high value keywords, you're showing where to put those, like in the beginning of the title or the first bullet point, or like that,
well, so
basically.
there's a filter for words and phrases, and then based on that TSI, you can rank those keywords on the highest TSI. So that means that they're most relevant and they have the highest volume. And the listing manager allows you to fill that out. Now, there are things that we know when it comes to your title is extremely important when it comes to optimization. And so you want to pull and extrapolate, okay, what are my highest TSI words and phrases? And then build out your listing right there natively in the listing manager with those with that filtering in mind.
Mhm. Oh, that doesn't update the listing though, does it?
No. Right now
No.
you can direct pull, but there's no push,
Gotcha.
which we've had feedback. That's how it's been originally set up. We've actually had feedback that people like that being removed, so they're not feeling like, oh man, I've clicked save and I've got to lose that
Fuck
information.
something up. Yeah.
Yeah, yeah. You can actually save version history, so that way when you're continuing to get data, again, one of the really cool features of Seller.tools is that it automatically harvests keywords. So it makes keyword harvesting extremely passive. You get a notification, you take a look at those keywords, say if you want them or don't, and that's it. It's, again, if we had this stuff 3 or 4 years ago, I mean, we would be in a whole different place. I mean, and it's so far ahead of the competition. Again, if everybody else isn't using Amazon data and we are, the sky's the limit.
Yeah, dude. Yeah. If you had that years ago, maybe you would have gotten a 7x EBITDA
I know.
multiple.
I didn't want to say that. I knew Chris
Yeah.
would rub it in. No.
Awesome. Cool, dude. All right, man. Well, that wraps us up then. We went over by about 7 minutes. That's okay. Um, it was awesome chatting with you, bro, as always. I'm really glad we did this. It was super fun. From the comments, it's obvious that it provided a lot of value to the viewers, and the replay will be available, we usually get in the mid hundreds of views on that. So hopefully, a lot more people will be able to get value from this as well, beyond just the live participants. So
Awesome,
yeah,
man.
man.
Thank you, Chris. Really great chatting with you. We'll have to do it again soon.
Yeah, hell yeah. All right. Bye, everybody.
Thanks, everyone.